Bismillahirrahmanirrahim. Selamat datang ke Bank Negara Malaysia pada sidang akhbar ini, pertumbuhan ekonomi negara serta perkembangan monetary dan kewangan pada suku pertama tahun 2014 akan diumumkan. Ekonomi negara mencatatkan pertumbuhan yang lebih tinggi pada suku pertama, iaitu sebanyak 6.2% berbanding dengan 5.1% pada suku keempat tahun 2013. Permintaan dalam negeri yang lebih kukuh dan ekspor bersih yang merekodkan pertumbuhan positif telah menyumbang kepada pertumbuhan ekonomi yang baik ini. In the first quarter of 2014, the global economy experienced a moderate expansion. The US economy experienced a slower growth due to adverse conditions, while the recovery in the euro area continued but at a modest pace. And in fact, some of the numbers were not as positive that have come out recently. In Asia, a number of economies grew at a slower pace as domestic demand was affected by country-specific factors. Financial market conditions were volatile during the quarter, reflecting growth concerns and monetary policy developments in the US, as well as heightened geopolitical risks. In emerging markets, financial markets were affected by country-specific factors, and during the quarter, monetary authorities maintained accommodative policies. The Malaysian economy registered a strong growth of 6.2% in the first quarter of 2014, compared with 5.1% in the fourth quarter of 2013. The strong growth was driven by a stronger expansion in domestic demand and a turnaround in exports. In terms of quarter-on-quarter growth, the Malaysian economy grew by 0.8% on a seasonally adjusted basis. Domestic demand remained as a main anchor of growth, expanding at a faster pace of 7.4% in the first quarter. Public sector spending recorded a stronger expansion as higher public consumption spending offset the decline in public investment. Private sector activity remained robust during this period. Private consumption growth expanded by 7.1%, while private investment remained strong, increasing by 14.1%. The continued strong growth in private consumption during the first quarter was supported by stable employment conditions and continued wage growth. And gross fixed capital formation grew by 6.3%, driven by robust private sector capital spending amidst a contraction in public investment growth. Growth in private investment remained strong at 14.1%, underpinned by capital spending in the services and the manufacturing sectors. Public investment declined by 6.4%, reflecting lower capital spending by both the federal government and public enterprises. The strong growth in gross exports in the fourth quarter of 2013 continued into the first quarter of 2014, driven by a broad-based expansion across all product segments. Notably, E&E exports continued to grow at a double-digit pace, driven by strong demand for semiconductors. Higher gross exports also reflected the higher commodity prices, particularly for palm oil and LNG. Gross imports, however, expanded at a more moderate pace during the quarter, reflecting the decline in capital imports and a slower increase in intermediate imports. The current account surplus, therefore, increased to 19.8 billion ringgit during the quarter, or to account for 7.9% of GNI during the quarter. and this was supported by a trade surplus and a lower deficit in the services and income accounts. On the supply side, all economic sectors except for mining recorded a stronger growth in the first quarter. In the services sector, performance was sustained at 6.6%, supported by improvement in the finance and insurance subsector and sustained growth in the consumption and production-related services. Activity in the manufacturing sector increased by 6.8% due to better performance of the export-oriented industries and continued expansion in the domestic-oriented industries. The construction sector expanded by 18.9% during the quarter, and the robust growth was driven by the residential subsector, reflecting a strong construction activity in the high-rise property in the Klang Valley, Penang, and also Johor. And this was also reinforced by stronger growth performance in the non-residential and civil engineering subsectors. The mining sector recorded a lower decline of 0.8% due to a smaller contraction of output of crude oil. Inflation averaged 3.4% in the first quarter, and the increase in inflation during the quarter was on account of domestic cost factors arising from the upward adjustment to electricity tariffs and the price of RON 97 petrol. Core inflation rose by 2.5% during the quarter, driven by an increase in rentals and some spillover effects of higher costs of prices of other goods and services. Interest rates remained stable in the first quarter of 2014, reflecting the unchanged OPR. And while inflation has stabilized in the recent months, it is expected to remain above its long-run average, which is about 3%. And the series of macro and microprudential measures that have been implemented since 2010 have had a moderating impact on growth, in particular of household indebtedness. Nevertheless, there is close monitoring on whether the ample liquidity and relatively low cost of borrowing could lead to broader buildup of financial and economic imbalances. Going forward, the degree of monetary accommodation may need to be adjusted to ensure that risks from the accumulation of such imbalances do not undermine the growth prospects of the Malaysian economy. The ringgit appreciated against the US dollar by 0.4% in the first quarter. The expectations of stimulus measures in China and the continued accommodative monetary policy in the United States led to inflows into regional financial markets towards the latter part of the quarter, after a period of portfolio outflows earlier in the quarter. Against other major and regional currencies, the ringgit performance during the quarter ranged from an appreciation of 3.3% and a depreciation of 2.9% was the main part of the range that the ringgit was somewhere in between. And year to date, the ringgit appreciated against the major and regional currencies, appreciating against the US dollar by 1.4%. Going forward, regional currency and financial markets will continue to be influenced by the shifts in global liquidity and capital flows. Growth in the net financing through the banking system and the private debt securities market remains stable and at 9.6% as at end March, and with higher loan disbursements during the quarter. The steady growth in net financing has continued to provide important support for economic growth. The growth in outstanding banking system loans extended to businesses and SMEs increased by 8.6% and 13.2% respectively. So SMEs show stronger growth in terms of increasing by 13.2% as at end March, and loans disbursed by the banking system to SMEs remain robust at 55.9 billion ringgit. Demand for new financing by businesses remains strong, with loan applications higher by 1.1 billion compared to the previous quarter. Meanwhile, the growth of banking system outstanding loan to household moderated to grow at 11.7% at end March. Domestic financial stability during the first quarter remained to be preserved, and this is evidenced by the continued functioning of financial intermediation that supported economic activity and orderly conditions in the domestic financial markets despite the persistent volatility arising from external developments. And then, of course, we had sustained public confidence in our domestic financial system. The banking system resilience was also reinforced by sound and well-capitalized financial institutions. The level of capitalization of financial institutions is strong, with sufficient buffers to absorb potential extreme financial market conditions and adverse macroeconomic scenarios. And this is based on our stress test that is conducted by the central bank. There were shifts in the direction of portfolio flows in response to global developments during the quarter. Nonetheless, portfolio flows were well intermediated by the domestic financial system. This was supported by the deep financial markets and the presence of a pool of strong domestic investors in our financial system. As a result, average volatility in the equity and bond markets improved while trading liquidity remained intact. The moderation in aggregate household debt mainly reflected in slower growth of financing for personal use and the purchase of properties and motor vehicles. Overall, asset quality of financial institutions remains stable, supported by sustained debt servicing capacity of borrowers. The impairment level was low at 1.2% of total bank lending to the sector. That is, for the household sector, the non-performing loan level remained low. And credit risk exposures to business sector remained stable, supported by the improved interest coverage ratio and stable leverage position in 2013. Impaired loans accounted for 2.8% of total business loans, unchanged from the previous quarter. Going forward, while there will continue to be uncertainties, the recovery in the global economy is expected to continue, and the improvements in advanced economies will support the expansion of international trade. In Asia, while domestic demand is expected to moderate, most will benefit from the improved external environment. For the Malaysian economy, growth will remain anchored by domestic demand, with additional support from the improvement in the external environment. Exports will continue to benefit from the recovery in the advanced economies, while private domestic demand is expected to remain the key driver to our growth. And going forward, the Malaysian economy is therefore expected to remain firmly on a steady growth path. And that concludes the presentation of the quarterly economic performance. I would now like to take this opportunity to announce that with effect from the first quarter of 2014, Malaysia has redefined its definition of the external debt. And this is in recognition of the significant development in the depth and breadth of Malaysia's financial markets and the consequent increase in the participation of non-resident investors in ringgit-denominated debt securities in recent years. The previous definition focused on non-ringgit-denominated debt, and this redefinition takes into account the residency of holders of both Malaysia's ringgit and non-ringgit denominated debt. And following this redefinition, non-residents holding of ringgit-denominated debt securities and non-residents deposits, trade credits, provided by foreign trade counterparts and other debt liabilities will now be included as part of Malaysia's external debt. And the wider external debt coverage is consistent with international best practices. With the redefinition of external debt in the first quarter of 2004 would amount to 700.1 billion ringgit, and the additional 372 billion when compared to the previous definition is mainly due to non-resident holdings of Malaysia's debt securities. In fact, 62% of this increase is accounted for by non-resident holdings of ringgit-denominated debt securities. So in other words, this new definition is not a reflection of increase in foreign borrowing, but rather non-residents holding our existing ringgit-denominated debt. And therefore, it should be stressed that the high and increasing participation of non-residents in our domestic debt market is not a major cause of concern because these debt securities are ringgit denominated. Therefore, there's a lower risk of currency mismatches. The country's foreign borrowing in the form of non-ringgit loans continues to remain relatively small and has not been rising. Therefore, the higher number in this new definition does not reflect the increased foreign borrowing, but reflects the greater participation by non-residents in our domestic financial markets, reflecting the maturity and the development of our markets. And within this definition, it is important to note that Malaysia's indicators remain well within the recommended international benchmark. Malaysia's external debt position based on this new definition is 65% of GDP within the international threshold of between 60 to 90% of GDP. And Malaysia's reserves is 1.3 times its short-term external debt, higher than the recommended one-time coverage. So then Malaysia's external debt position continues to be supported by our strong fundamentals. Malaysia's external indebtedness indicators, such as reserves to short-term external debt cover and total external debt relative to GDP, all remain within the international benchmark for prudence and external soundness. And going forward, Malaysia's macroeconomic fundamentals would continue to support our monetary and financial stability. These include, of course, the fact that we have high level of reserves, large presence of domestic institutional investors, deep and diversified capital markets, resilient financial institutions, and most importantly, we have a robust regulatory and supervisory framework. So that concludes the presentation for today.